You are listening to Talk Tickers. It is Wednesday, January 28th, 2026, and today we are looking at a classic, a real battle between the fundamentals and the tape. We're breaking down the Q4 2025 earnings call from the American steel giant, Nucor Corporation, ticker NUE.
Good morning. This is one of those prints that really separates the tourists from the locals.
Oh, absolutely. I mean, you have a situation here where the management team is, effectively popping champagne. They're claiming the safest year in history, pointing to record backlogs.
Right.
But if you look at the stock market reaction, investors basically threw that champagne right back in their faces.
It was a rough open, to say the least.
So our mission today is to figure out who's right. Is this sell-off a warning sign about margin compression?
Or is this a massive buying opportunity based on what we're calling the CAPEX cliff?
Exactly. That's the multi-billion-dollar question.
Because on the surface, it's ugly. But if you look at the cash flow statement for 2026, it tells a completely different story.
Okay, let's start with the ugly part. Let's rip the Band-Aid off and look at the results snapshot. What happened yesterday morning?
It was a miss, plain and simple. The street was looking for an adjusted earnings per share of, what, $1.91?
$1.91, yeah.
Nucor came in at $1.73.
Ouch. That's a 9% miss? That's not small.
No, and the top line came in light as well.
What were the numbers there?
$7.69 billion versus a consensus of $7.87 billion.
And the market, did not forgive them for this.
Not at all. And you have to remember the context here. The stock had literally hit a 52-week high of $183.32 the day before.
The day before. So expectations were sky high.
Exactly. So when they missed, the trapdoor just opened. The stock dropped about 3.4% initially, closed the session down 2.3% at $173.58.
So investors who bought that breakout on Monday were underwater by Tuesday lunch. But there's always but with Nucor, it wasn't a total disaster on the profitability side, was it?
No, and this is where the nuance starts to creep in. Even with the miss, they still posted EBITDA of $918 million for the quarter.
And for the full year.
$4.2 billion. So, this is not a company in distress.
And the balance sheet.
A fortress. They ended the year with $2.70 billion in cash and short-term investments.
And they're putting that cash to work.
They are. They repurchased 0.7 million shares in Q4 alone at an average price of about $145, and they raised the dividend to $0.56 a share.
Which marks what, 50?
53 consecutive years of dividend increases.
53 years. That is a track record you just don't bet against lightly.
No, you don't.
Okay, so headlines bad, balance sheet good. Let's get into the segments. Where did the pain actually come from? A miss like that has to be specific.
It came from the steel mill segment. Pre-tax earnings, there were $516 million, which, sounds like a lot.
It does.
But it was down about 35% quarter over quarter.
35% in one quarter.
Yeah. And it was a mix of lower realized pricing and some outages. Basically, the price they could sell steel for dropped faster than their costs did.
Okay, so a margin squeeze. The other segments.
Steel products held up better at $230 million, and raw materials chipped in about $24 million.
So the main engine sputtered. But let's zoom out. We're not just here to read the news ticker. We're here to analyze the business trajectory. And the single most important narrative coming out of this call was about capital allocation. We're calling it the CapEx cliff. Walk us through this.
This is the pivot point for the stock. If you've been watching Nucor, the story for the last few years has just been spend, spend, spend.
Right, building out.
Exactly. 2025 was a huge investment year. They poured $3.4 billion into capital expenditures.
$3.4 billion. That's a massive outflow of cash.
It is. But on this call, they guided for 2026 CapEx to drop significantly. They're guiding to roughly $2.5 billion.
So that's almost $1 billion less leaving the building.
Correct. And in the world of free cash flow, a penny saved is a penny earned. Management said explicitly they expect meaningfully higher free cash flow in 2026.
It's simple math, right? Spending goes down.
And here's the kicker. EBITDA from the projects they just finished starts coming online.
They called it a transition from spending to earning.
That's the perfect way to frame it. And they even broke it down. Of that $2.5 billion for next year, about $800 million is just maintenance, keeping the lights on.
Okay.
The rest is growth, and almost all of that is going into one massive project, the West Virginia sheet mill.
We will get to West Virginia in a second because that is a beast.
Yeah.
But first, let's talk about the stuff that's already done. They mentioned 4 projects moving from construction to ramp up.
Right. This is the growth engine waking up. You've got the Lexington, North Carolina rebar micromill,
Okay.
the new melt shop in Kingman, Arizona, the coating complex in Crawfordsville, Indiana, and the towers and structures facility in Alabama.
And just to be clear for everyone listening, when we say ramp up, we mean these places are built, the ribbon's cut. Now they're actually starting to churn out product to make money.
Precisely. They're moving from a cost center to a profit center.
Okay.
And management actually quantified this impact, which was great.
Oh, they put a number on it.
They did. They said those 4 completed projects, plus progress at their Brandenburg plate mill, are expected to add $500 million in incremental EBITDA in 2026.
Wait, hold on. Let me just do the math here. So they are spending roughly $900 million less on CapEx.
Yep.
And they are expecting to make $500 million more just from these new projects.
That is the bull case right there. You have a $1.4 billion swing in cash availability just from those 2 factors.
Before you even talk about market demand or pricing.
Right. That's why long-term investors are looking at this dip and just salivating. It's a huge inflection point in cash flow generation.
It effectively turns the company from a construction site back into a cash register.
That's a great way to put it.
Okay, let's talk about the big one, the West Virginia sheet mill. This is the largest remaining capital suck, if you will. Why is this mill so special?
It's a massive strategic shift. To get this, you have to understand how Nucor makes steel. They're an electric arc furnace, or EAF, producer. They melt scrap metal.
Right, they're recyclers. The legacy guys use blast furnaces.
Exactly. And typically, EAF producers have a hard time making that really high-end, perfect surface steel you need for the outside of a car, the exposed automotive grade.
Because any tiny impurity in the scrap shows up on the hood of your new car.
Precisely.
So historically, Nucor couldn't really play in that sandbox. They could do the frames, the internal parts, but not the shiny bits.
Got it.
But West Virginia is designed to crack that code. They're targeting exposed automotive and also consumer durables. Think washing machines, refrigerators.
The stuff that has to look pretty.
Exactly. And the geography here is crucial. They're building this right in the Midwest-Northeast corridor. Right now, Nucor only has about a 15% market share in that whole region for sheet steel.
So it's a conquest. They were going into their competitors' backyard to steal market share in high-margin products.
That's the plan. And if they pull it off, it could change the multiple on the stock. It makes them less of a commodity player.
Now let's pivot to demand. Because you can have the best mills in the world, but if nobody wants steel, you're toast.
Management seemed surprisingly bullish.
Bullish is an understatement. They use the phrase, historically strong backlogs.
Let's put the numbers on that. What does the order book actually look like?
Steel mill backlogs, up nearly 40% year over year.
40%. That's massive.
It is huge. Steel products backlog is up 15%, and the structural backlog, the beams for big buildings, is at record levels.
So the earnings miss was about the past, but the order book for the future is overflowing. That's a huge disconnect.
It is, and you have to ask, where is all this steel going? Because commercial real estate office buildings is effectively dead, right?
Right. This is where it gets really interesting. They highlighted 2 specific megatrends. Energy infrastructure, so wind towers, transmission lines.
Sure.
But the one that caught my ear and honestly shocked me a little was data centers.
This is the standout stat of the call for me. It completely changes how you view the company.
I nearly spit out my coffee when I read this. Break it down.
Management stated that Nucor supplies 95% of the steel demand for a typical data center.
95%. That's a monopoly. How is that even possible?
It's an effective monopoly on the system, yes. Think about it. A modern hyperscale data center needs massive structural beams for the roof. It needs warehouse racking for the servers. It needs overhead doors, joists, decking.
And Nucor makes all of that.
They have bought or built companies that make all of those things. So if you're building a hyperscale data center for AI, you are effectively writing one check to Nucor.
That completely reframes the narrative. We all think of AI as chips and software, NVIDIA.
Right.
But the physical shell of the AI revolution is made of steel. And it turns out it's Nucor steel.
It bridges that gap between cyclical steel company and secular growth infrastructure play.
And their Q1 guidance reflected this confidence.
Absolutely. They expect earnings to increase across all 3 segments.
Driven by what? Just more volume?
Higher volumes, yes, but crucially higher realized prices, especially in feet. They believe the pricing bottom is in.
Which brings us to the elephant in the room. Macro. Tariffs, trade, politics. What's the landscape there?
It's a pro-America trade environment. to quote management. Imports have dropped significantly.
How much?
A year ago, imports were taking about 25% of the market. Late 2025, that number dropped to somewhere between 14 and 16%.
Wow. That is a massive swing. That's domestic producers taking back 10% of the entire market.
And it's largely due to Section 232 enforcement. The tariffs are back, no exemptions, and they are holding. Management was very clear they expect that to continue.
They also made an interesting point about pricing, didn't they?
Yeah.
Pushing back on the idea that U.S. prices are artificially high.
They did. They argued that U.S. steel prices have separated from world prices not just because of tariffs, but because U.S. demand is just that strong while the rest of the world is weak.
So if demand is high, imports are low, and backlogs are up 40%. Why did the stock drop yesterday? We have to explain this lag effect.
It's all about the lag effect. We see this in steel cycles all the time. Nucor's costs, scrap metal, energy, those move in real time.
Right.
But a lot of their selling prices are locked in contracts that reset based on lagging indices.
So in Q4, their costs were high, but they were delivering steel that was priced based on lower spot prices from back in the fall.
Exactly. Spot prices for sheets started rising in November and December, but their contracts hadn't caught up yet. It squeezed the margins. Q4 was a margin trough.
So the bet for investors right now is that Q1 is the snapback.
That is the whole thesis. As those contracts reset to the higher spot prices, margins should expand rapidly.
So the market punished them for a timing mismatch that is already fixing itself.
That's the argument. The market saw a snapshot of a squeeze, while management is looking at a movie of expansion.
It really is a fascinating setup. You've got the CapEx cliff creating cash flow, the lag effect resolving, and this hidden AI infrastructure play.
A lot of moving parts, but they all seem to be moving in the right direction for 2026.
All right, let's get to the part of the show everyone waits for, the part where we get a little creative, a little speculative.
The dangerous part.
Exactly. This is not financial advice segment. We are not advisors. Do not do what we say. It's just for fun. But based on this call, I've got a trade idea. I'm calling the Rusty AI ARB.
The Rusty AI ARB. Okay, I'm intrigued. Lay it on me.
Okay, everyone is chasing the AI boom. Buying NVIDIA, buying the hyperscalers, paying 50, 60, 80 times earnings.
It's a very crowded trade. Everyone is on one side of the boat.
Incredibly crowded. But Nucor just told us they have a 95% monopoly on the physical shell of these data centers. And they're trading at, what, 10 or 12 times earnings?
Give or take, yeah. It's cheap.
So here's the trade. You go long Nucor, ticker NUE. You treat it as a stealth tech infrastructure play that hasn't been re-rated yet.
Okay, I'm with you. What's the other side of the pair?
You shorted a generic homebuilder ETF.
Ooh, interesting. Why home builders?
Because of interest rates. The economy is hot. That's why Nucor is busy. A hot economy means rates stay higher for longer.
And who hates high rates?
Residential housing. Who doesn't care about rates? Microsoft and Google building multi-billion-dollar data centers to win the AI war.
I see the logic. Industrial CapEx is basically interest rate agnostic right now because it's an arms race. Residential is highly sensitive.
Exactly. So you bet on the industrial AI CapEx with Nucor, and you bet against the interest rate sensitive residential sector.
And the catalyst is the Q1 earnings print.
That's it. When that CapEx cliff we talked about actually hits the balance sheet, suddenly the free cash flow yield on Nucor explodes. The algorithms that screen for that are going to light up like a Christmas tree.
And they'll be forced to re-rate the stock from a steel mill to industrial tech.
That's the dream. The Rusty AI ARB. Remember, this is for entertainment purposes only. Do not blow up your portfolio because I like the word rusty.
But it is a plausible thesis. It connects the dots.
Let's wrap this up. We've covered a lot. Q4 was messy. Costs ate the margins. The stock took a hit. But looking forward.
Forward looks incredibly strong. You have backlogs up 40%. You have CapEx dropping by nearly $1 billion. You have a new mill opening up the auto market.
And you have that import number sitting at 14%.
That is the floor. If imports stay low and demand stays high, Nucor is just printing money.
So here's my final thought for the listener. Management effectively said they are done spending and ready to start harvesting. Now, if that West Virginia mill actually allows them to crack the auto market, really crack it, does this stock deserve to trade at a cyclical discount anymore?
That is the question. If they can dampen the volatility of their earnings by entering these stable high-end markets, the PE multiple itself should expand. We could be looking at a structural re-rating of the business.
And if that happens, buying this dip at $173 might look like the steal of the century. But hey, that's just talk ticker stalking.
Indeed.
Thanks for tuning in to this breakdown of the Nucor Q4 2025 earnings. We'll be back next time with another deep dive. Talk Tickers signing off.